My exclusive interview with Jamie Dimon, the J.P. Morgan Chase chairman and CEO, telling me about the beginnings of a succession plan. It includes changes at the top of the company, including 2 women getting big promotions. We previously discussed a skills training program that Dimon is also spearheading and how technology is affecting jobs across industries. Here's part 2 of my exclusive interview. We've got so much technology and automation now in business, so you're putting some $350 million into this program. Where are the most important issues in terms of machines taking over jobs?
I think the way the American public should look at it, machines have always been taking over jobs. We went from 40 million people or 30 million people working in farms to 1 million. So that took 30 or 40 years, and those people got other, probably better jobs. Some of those back-breaking work. So a lot of these things are replacing back-breaking work, but there's still jobs today available in coding, nursing, medical, the trades. But some people love the trades. We need to build more homes in this country. So there are tons of jobs, and my view is we just got to have a kind of a continuous program of retrain our people and to adjust to the new world. The GDP will be growing. We got to share the wealth a little bit. We can adjust fine, but we have to have programs like these to make sure that adjustment takes place properly. And
it increases productivity.
It increases productivity.
Which adds to growth.
And more than that, wages. People like to work. They have better household formation, better social outcome. There's dignity to a job. So all of these even starter jobs usually lead to a second job and a third job and a fourth job. And with the opioid problem, all these problems get better when society's healthier and the economy is sharing it with everybody a little bit more.
You mentioned wages. You raised the minimum wage a while ago. Bank of America followed your lead, and now is talking about $20 an hour in the next couple of years. Do you worry about the impact of that on small business? A lot of small business owners say to me, look, if I have to raise the minimum wage to $18 and $20, I've got to cut jobs.
I understand that. So I do. I think, first of all, if those of us can afford it that's not terrible for them. I think it's a little bit different when people raise the minimum wage, and it may drive certain small businesses out of business. So I think locally you can raise the minimum wage. You should make sure you do the right one here. It won't be the same number as New York, because that's what had an adverse effect. And I think for companies to compete is good. So today, for the first time in like a long time, low-end wages are up like 20% the last 2 years. That's what we all wanted. And now we're all complaining about that a little bit. So done properly, we're going to be fine. But I also believe in expanding things like the earned income tax credit. I think we have to make low-skilled jobs pay more, and you have better social outcomes. And we have a thing called the earned income tax credit, which pays a single mother with 2 children making $14,000 a year can get a $6,000 tax credit. And I think that kind of thing is a very good program because it incents work, which leads to dignity, et cetera. So there are a lot of things to do. I worry about that a little bit. I get a lot of complaints now, but that's kind of what we all wanted.
Jimmy, you reported earnings last week. A lot of talk about you were more optimistic than in the fourth quarter. When we spoke last, we were talking about the fact that there wasn't any high-yield issuance, debt issuance in the month of December. Characterize the economy, and what was the takeaway from your first quarter earnings?
We spoke as like the first week or second week in January. Yep. The sentiment in the fourth quarter had gone from hugely positive to hugely negative. There were some modest good reasons. There was a slowdown in growth around the place. People got worried about trade. We had the government shut down. But it was a huge overreaction, which I think I kind of mentioned to you then.
You did.
And that the market had opened up right away. In fact, I think on my way home that day, I got the call the first high-yield bond deal was being done. And I said, once the first one gets done, it's going to open the whole spigot. And I think that reaction was just a massive overreaction. What we see that in the U.S. is that the American consumer, their balance sheet, their incomes are strong, not weak. More people are going back to the workforce, which is a good thing. Companies are in very good shape. Profits are good. Capital expenditures are still going up. Business and consumer confidence at high levels. Housing's in short supply, so it's kind of a tailwind. And the Fed is on pause, which I think they did the right thing, which means it's going to give people a little more time to adjust to a little bit of a slowdown. But to us, it seems like it's just a little slowdown. And it doesn't, other than trade, I'm not sure what's going to stop it in the next year or two. Now, of course, one thing will stop it one day, geopolitics, some geopolitical trauma or some terrible event somewhere, or maybe you do have too much growth and inflation, maybe. But you don't see that today, and there's no law that says we won't have growth for another couple of years. So I'm prepared for it to get bad, but I'm not predicting it. I'm simply saying, no, you could actually have a pretty good environment for a while.
So you don't see a recession in the next couple of years?
I don't.
So where's the growth? Is it the consumer or the corporation? Because I know that CapEx spending came up a little bit in the last 6 months, and then people were worried that it was sort of, stalling out. Is it the corporate sector or is it the consumer that's most strong right now?
The consumer is, the consumer balance sheet, debt service levels, asset levels is excellent. Okay, and as good as it's been for 30 years or something like that, and with wages going up at the low end, their credit is getting better and not weaker, and more people going back to the workforce. I still think there might be 1 million or 2 or 3 million left. We have problems we've got to fix, like the opioid problem, but so the consumer's in very good shape. Their confidence is good, which is important. Business confidence is good. After tax reform, actually capital expenditures went way up. Okay, and they've been coming down by quarter, but they're still year over year higher. And as it turns out, the companies doing stock buybacks are doing more capital expenditures, not less. And the thing way you got to look at capital, it's not what they did in that quarter, the first quarter, the second quarter. It's this capital that's being retained here. And you're talking about trillions of dollars over years that will be retrained and reinvested in the United States. So even the money that is going to stock buybacks is capital that's here that's being deployed. So you might have a higher dividend, or you might be an investor, you're going to reinvest it in something else, but that's all redeployment of capital. And that will have a positive effect. It's almost impossible to model it. But to me, you're going to see that effect. You are seeing it. And companies are spending. It's not like capital expenditures are going down. And this notion that somehow companies spent more on capital expenditures in the good old 50s or 60s, it's higher today than it was in the 50s or 60s. I mean, people have to look at the facts when they say some of these things.
Yeah.